Katerina, clearly your colleague at Morgan Stanley is the one on the bearish end of that spectrum. So that's the camp you're in as well. Where does that downside come from?
Kailey, thank you for having me on. And it is a perfect storm of negative pressures on the market when you think about it. We have inflation, which is at the 40-year high and is crippling the profitability of the companies. We have Federal Reserve, which is aggressively raising rates, which is a solid strategy, but is perceived as negative by the market. And we have the geopolitical risk by the situation in Ukraine, which adds a huge element of uncertainty. And with all of this, we're finding ourselves smack in the middle of the bear market. But our view is that the market cycles in general are getting shorter. So what this means is that as we see the negative earnings revisions continue throughout this year, what it's going to lead to eventually is this normalization that we're looking for, and perhaps will serve as a catalyst for the next bull market. So our view is, yes, very bearish and negative at the moment. We do believe that there is some more downside in S&P 500. Specifically, at this point, we're down by, on S&P at about 12%. We think there is additional 7 or 8% that we have to be ready for in this kind of just continued cyclical declines. But, this is not going to last for long in our view.
Okay, so that gets us to around 3,800. You talk about the fast cycle, Katerina. How quickly do we get to 3,800? A lot of people are sitting with cash on the sidelines right now. They're trying to figure out when they should put that money to work. Is another 7% downside from here a good point to put that money to work? Do you think the pendulum could swing even further than that? Mike, for instance, does. Where should I put capital I've got dry at the moment, ready to deploy, back to work?
Well, guys, the timing is so difficult to predict. Again, we don't expect the cycle to be really long, but there is another side to this equation. We have inflation at 8.4%. So when you think about the cash that investors are sitting on the sidelines and the negative effect that this inflation of 8.4 is having on the purchasing power of this cash, we're not doing ourselves any favor by sitting in cash. So we have to find alternatives. And I know that seemingly it is so scary to buy into this market, but it might be the best course of action, especially in the sectors that pay higher dividends.
Katerina, I understand the argument about sitting in cash and the fact that inflation is going to erode that. But do I want my money to be further eroded by stock market declines? You're talking about the market going down from here. Why isn't cash a better alternative than being in a falling market?
Well, Guy, because the timing is so difficult to predict, one of the best strategies here to deal with these bear markets is dollar cost averaging. Because again, in the long run, any type of investment here, especially in the sectors that pay higher level of dividends, would be a good move. The difficult part, it is when do we make that investment? And the best course of action is not to make an entire move all at the same time and invest all of our cash, but maybe do it gradually over time. Because we think that we're in this bear market environment, which is going to continue, and eventually we will get to these deeper, down levels of S&P 500.
Okay.
And for the long run, it will present a great opportunity.
Okay, so Katerina, if you want to be invested, cash is not the place to be. Where are the safe spots to put your money? Because the 60-40 portfolio was toast in April.
Kailey, it's a big challenge because it's not very often that we see both stocks and bonds being down at the same time. But it also gives us the opportunity to pick up some really high quality investments at the prices that are generally below the average and at valuations that look significantly more attractive than where we saw them, even last year. And when we look at the market and at the opportunities, at this point, we believe that this is a stock picker's market where individual positions are much better positioned the broad market indexes. The specific sectors that we like are healthcare, and within healthcare, large pharmaceutical companies, health insurance companies, are positioned very well in this post-COVID environment. Real estate, REITs specifically, are historically viewed as a very effective inflation hedge. Utilities, in any type of high-quality dividend-paying place would work really well, because we have to look at the smart market, and we have to look at the investment portfolios through the prism of income production, through the prism of dividends, and what can we generate in income to get us through this very volatile, very nerve-wracking, environment in the market. And what we caution investor against is trading into the fears, because when market is this volatile, we tend to make mistakes.
Katerina, once the market has bottomed, does it come straight back up again? Does it stay down there? I'm wondering what you think the second leg of this is going to look like. We're going down pretty fast. Is it going to be a V-shaped recovery? What kind of a recovery should we expect in these equity markets?
Guy, the real question here is, are we going to have an economic recession, which at this point is very hard to be seen? And in our view, we're looking at the next year, and we think it seems unlikely. We actually think that we are not going to have an economic recession, in which case we will start seeing the beginning of the bull market, perhaps even towards the end of this year. But there is a possibility of recession because we're dealing with supply chain interruptions. We're dealing with all of these uncertainties that are on the table right now. And if the possibility of the recession will become more prominent than where it is right now, there is a possibility that, the bull market and the beginning of it will be somewhat delayed. But we believe it's coming. It's on the horizon.